Hi and welcome back to Property Insight. My name's Mark Ashworth.
And I'm Neil Harding.
And on today's video we're going to be talking about HMRC's position on the tax avoidance schemes that were set up to avoid the issues around Section 24. So if you've heard about any of those schemes where you've got properties in your own name and you want to incorporate your portfolio to best be treated for tax, then listen on, and that's what we're going to be talking about today.
The interesting thing here is HMRC have actually published their position in April 2025 on the government website under Spotlight 69. So if you wanted to Google, we'll put in the links to the show notes. The link to Spotlight 69. But
so it's just sort of some kind of like what?
Like a bulletin announcement, you know.
Okay.
A sort of, you know, this is HMRC's position on what some property investors have been doing to navigate a way through, let's say, the problems created for them on tax from Section 24, where landlords who own property in their own name are no longer able, and haven't been for years now actually, no longer able to be deducting mortgage interest as an expense for tax purposes against their rental income.
Sure. So typically what people have been doing is turning their sole properties personally owned into a limited liability partnership, for example, and then for a period of 2 years, and then incorporating into a limited company, thus avoiding various taxes along the way, and then obviously then being able to offset all of the mortgage interest. So what is HMRC's position? What are they saying in this Spotlight 69 article?
So they are saying, I'm going to paraphrase, we don't believe in it. In our view, it doesn't work. Don't do it. And if you're in the middle of doing it, or if you've already done it, then speak to us and let's have a conversation. That's in a nutshell, that is basically what they're saying. If people are watching this and wondering, well, what actually is this scheme that HMRC don't like? Well, the idea of it is that you take the properties that you've described, Mark, that people would own in their own name, and you ultimately get them into a limited company where you can deduct mortgage interest against rental income, but you do so via a limited liability partnership. So you go probably 2 years at least into an LLP and then incorporate into a limited company from the LLP.
And let's be clear, the reason why people were doing that is to avoid stamp duty and capital gains tax. Because clearly you're selling your property or you're moving your property to a limited company. Normally, if you were to move from one entity to another, that would trigger some kind of crystallisation, and so therefore you'd have to pay some kind of capital gains tax or some kind of tax, and in particular stamp duty, etc. So people are using these schemes in order to avoid those additional charges to get them to limited company status.
That's right, yeah. And by claiming incorporation relief, by doing it that slightly more convoluted way, let's face it, there's a way to do it which means that you can claim incorporation relief via the LLP operation before you get to a limited company, and yes, you avoid capital gains tax, you avoid stamp duty, but you get all of your properties into a limited company, which is what you wanted to do.
It's an interesting idea, and I think that lots of people were quite keen to, particularly those people who have had portfolios for a long time, that are professional landlords, because obviously the whole Section 24 thing, when it originally came up, I think it was a way of the government basically saying, or trying to avoid too many amateur landlords that wanted to try and professionalise the market. That's certainly the way I saw things. And so obviously some people were penalised, even the professional ones, because they're owning their property in their own name. And it's quite a significant impact on those landlords. So you can understand why, there were people were keen to sort of try to provide a solution for that. And it wasn't that the solution wasn't that it was illegal. It's quite a legal way around doing it, although not necessarily in HMRC's eyes.
Exactly, and it's a brave person that takes on HMRC's opinion. To be contrarian to their view, especially with published view is, of course, it's up to individual people what to do. We should probably at this point put in our caveat comments about take professional tax and accounting advice. This is not advice in any way, never will be. We're trying to bring you the news and help you as best we can.
So just what's your opinion on this Spotlight 69 thing being a little bit under the radar here? Because it's the first I've heard of it, and you said that it was quite, you listened to quite a lot of newsworthy stuff with regard to property, and you found that it hasn't really come up.
Yeah, I've been quite surprised that I've not seen anybody else talk about it. The Spotlight 69 being published, unless it's just passed me by, but I know a lot of property investors. I listen to a lot of social media, podcasts, news bulletins, and as far as I can see, no one's really talking about it, which is just a little bit of a surprise because ultimately HMRC have put it out there, and I know there are a lot of investors that have gone this route, and I think and there are a lot of investors that are thinking about going through this route, so I think it's definitely worth being armed with that information.
Check out the links below, have a look and have a read. If you've got any comments or questions, obviously pop them below. Like and share the video, of course, and we look forward to seeing you on the next video.